And now to our discussion segment. Global tensions in the Middle East are once again sending shock waves through the energy markets, pushing oil prices higher and uncertainty into the global economy. For Nigeria, an oil-dependent nation, the implications are mixed. Potential revenue gains on one hand and rising inflation, fuel costs and economic pressure on the other hand. But beyond the headlines, what does this mean for investors? How should portfolios be structured in a period where geopolitics is driving market direction? Joining me on the program to speak on how to navigate this wave of energy-driven volatility and protect wealth in uncertain times is Mr. Victor Olamide Mathews, a portfolio manager with Northern Asset Management Limited. You are welcome to Business Express.
Thank you very much, Nneka. It's my pleasure to be here.
Great. With fuel prices rising due to Middle East tensions, how exposed is Nigeria's economy to this shock?
Well, as you mentioned a couple of seconds ago, you said the implications are mixed, right? And everyone definitely has to agree with that. First, the positive side, that's the upside. We are going to see improvement in the volume or the value of foreign exchange inflows into the country, right? Trading above 64 barrels, $64 per barrel, which is stated in the budget. And the Brent crude oil trading around 107 to 109 as of today. It has been the above $100 per barrel over the last number of days. Shows that there is an excess in the amount of revenue that the Nigerian government can get from that, right? 60-70% above what they planned for. So if we can receive that level of amount from the sales of crude oil, then it's very good for the Nigerian economy in terms of our foreign exchange, as well as also when we take that, the gap, the spread can also improve our excess crude accounts within the Nigerian economy, the fiscal improvements in that level. However, the downside is also there too, because the inflation is being imported. Crude oil is being priced internationally. When you have a price, an instrument or a commodity priced internationally, is more exogenous on you, and you really have no effect, you have no influence on it within the Nigerian economy here. So prices have to go up in terms of the end product of oil, which is petrol, diesel, and other energy products. So that's the downside. So it's more like a structural paradox where we have the positive side and the negative side.
So for investors, would you say this is an opportunity or a risk moment for them?
It's unequivocally, it's a mixture of both, right? However, when we're talking about the opportunity, it depends on kind of investors what we have in this particular sector. Over the period that this has spanned, this is the 21st day, I believe, that the war has enriched. We have a number of stocks that have gone down in terms of the value performance over that period to date, right? Though we can't say the same for Nigerian stock market. Nigerian equity market is being quite resilient recently. However, some do see it as an opportunity to enter fundamentally good, fundamentally sound stocks or equities, for them to invest in these equities at this point in time, because over time, once we have a positive sentiment back in the market, it will improve their source of income and the dividend income they get from that instrument. However, in terms of looking at it as risk, when we're talking about individuals or investors who have limited funds in their hands, I don't think they should see much of it as they can take it as an opportunity, but they need to make sure they're able to survive within their means at the moment before they start thinking of how to make significant returns, not significant per se, but returns that are above where inflation is at the moment. So it's a mixture of both. We can't say it's just one size fits all.
In times like this, what should be the top priority? Is it capital preservation or aggressive returns?
Yes, I alluded to that in the last question you mentioned, right? I don't think absolute returns, or rather not absolute returns, aggressive returns should be the main focus now. Aggressive returns can lead to aggressive losses, and you need to first look at how you can preserve your income. However, not just preserving the income, but also trying to make returns that are slightly above or above where inflation is. That's what we call inflation adjusted returns. Inflation right now in Nigeria is around 15.06%. Treasury bills, right, which is like the risk-free rates we get within the market right now. And the last auction, the 364-day close at around 16.62. When you look at the yield on that, it's close to 19.9%. That shows there is a positive return on that. So individuals should look at trying to invest in these risk-free instruments and not excessively place their funds in areas where they think absolute aggressive returns can come. So capital preservation is the first thing. However, if you think you can make more returns, invest in risk-free rate instruments. That's where it goes.
How should Nigerians rethink their portfolio allocation right now?
So a number of things matter, right? However, one thing that has been ringing in my ears and a lot of investors' ears recently is adopting the barbell strategy. That is trying to check how we can invest in the short end and at the same time in the long end with due focus or huge focus on fixed income instruments. Interest rates have been high for 1 year plus within the fixed income markets. That doesn't mean the equities market has not been doing well. Equity market has also been doing well. The fixed income markets, however, we had initial plans or we had initial ideas that interest rates were going to go down this year. This is a black swan event happening. No one planned it was going to happen at the beginning of this year, and this started on February 27th, right? So people or individuals, investors see, especially the global investors, see that interest rates are going to be higher for longer for now, depending on the extent and as well as the gravity of the war, right? So if the war is going to extend past the immediate environment right now, we think interest rates are going to be high for the moment while we think of it right now. So investments right now should focus more on fixed income, right? Fixed income also, and if you want to invest in other assets, you should pick stocks that are fundamentally sound. I mentioned that earlier too. This is not a time for speculative investments. It's more of picking the stocks that you know are going to be able to weather the storm in this period. Stocks that are more of consumer staples, not discretionary consumer investments, consumers, right? So these are investments you can look at too in a view of that. So fixed income, yields are high, may go up, right, in this level, so you can also put your funds in some of the shorts, so you can be able to enter better yielding positions in the case that interest rates may go higher in the upcoming term. So those are the strategies I think Nigerians can adopt in the coming days.
All right. A lot of people have been moving in the direction of dollar-denominated assets like Eurobonds, domiciliary accounts, dollar mutual funds. Is that the right instinct, or are there risks people are not saying?
It's totally understandable. During times of uncertainty, dollar is seen, or dollar-denominated assets are seen as safe havens, right? They feel like when there are issues across the world, most of the things you can invest in are in dollars. Gold is a dollar-denominated asset, and it's one of the things. However, gold hasn't been living up to the expectations since the war started. However, there are other dollar-denominated assets, Eurobonds, as you mentioned earlier, foreign ETFs, those in the US, are also other countries too. If you earn in Naira, I don't see any need for you to convert to dollar, because you earn in Naira, most likely spend in Naira, right? Naira too has also been very, very strong recently, and it's been performing significantly better than what a lot of individuals expect. And when you look at it also in this view that we're going to be receiving a lot of foreign exchange inflows from these higher oil prices, that's through the government, our foreign exchange reserve is going to improve, which would definitely have a ripple effect, improve the level of the Naira compared to the dollar, because we have more dollar inflows coming into the economy. So this thing, so you don't need to really move your funds from Naira to dollar to convert your funds from Naira to dollar. However, if you're earning in dollars, I still believe that your funds, you can still diversify. Don't focus most of your funds in dollars and neglect the Naira, because Naira too also shows some good resilience and improvement and positive optimism. Let me put it the word optimism over the last number of months. So it's something you can spread. However, if you want to invest in the dollars, you should focus on Nigerian Euro bonds, right? It's it's been very, very attractive and also been resilient over a number of the years. You can put in dollar mutual funds are also very important too, because you can need to diversify that investment, as I mentioned earlier. So dollar, yes, it's good, but you have to be strategic as to what assets to hold and which one not to hold.
Okay, what about agriculture and agro-processing sector? You know, they keep coming up as sectors with high potential. As a portfolio manager, do you actually see strong returns there?
For now, agricultural sector may suffer a hit, especially due to it's a staple, right? It's not going to suffer. There's a level of inelasticity in terms of the price movement. Well, no matter how much the price moves, the effect of reduced demand can really significantly affect the way other discretionary consumer products would affect. So agricultural is also, you can enter at this point. However, you should enter and when to exit. Probably it's not really much of it to exit though, but it's something you can watch closely. But they are the vitals of the economy. People definitely have to eat, so if you have to eat, then you should know that it's something that people have a difficult time to stay away from. You can't stay away from agriculture, so it's a good one to go for.
Okay, so tell us, is this a time to hold cash, invest more, or stay on the sidelines?
Definitely not to stay on the sidelines. You shouldn't stay on the sidelines. Then cash, it depends on what you call cash, because cash can be in terms of its equivalent, but not the cash itself. Leaving it there in your bank account or in your savings account, savings or current account, is definitely going to erode your purchasing power. So what I mean by cash, in my view, is to invest in cash equivalents, near cash investment. Treasury bills is similar to cash because you can easily trade it in the secondary market. It's short term, right? So you can hold that as an investment pending the time to see where the market is going to go. If yields are going to rise in future, then you can put in those investments. When yields are high and you see it has attained its peak, right, you can invest those funds you take from your cash easily and invest in those high yielding fixed income instruments that will take you for a longer period, probably for a couple of years or 7 years or so. That's bonds. I'm talking about bonds. However, when you talk about investing in you have to be active in the market at the moment. You have to listen to the news every single time, listen to fund managers who provide advice on what to invest and what not to invest in. So staying in the sidelines is out of question. Having some cash and investing is definitely a dynamic way of doing that.
If the Middle East crisis persists, what long-term shift should investors prepare for?
Hopefully, it's not going to persist so long, but if it persists, which we have little or no control on, a number of things will change. First, in the energy side, a lot of things has happened within the last 5 years. Look at the Russian-Ukraine war. It made an acceleration in terms of looking for alternatives to oil, electric vehicles, solar energy, wind energy. These things are also going to continue to accelerate at the moment because a lot of countries are suffering, especially countries that have little or no reserves in terms of oil, countries that are significantly affected by the blocking of the Strait of Hormuz, talking about Japan, China, South Korea, India. Those are countries that have been significantly affected by that, right? And because of that, people want to look for alternatives to oil. So that's an area I think is going to be a shift. Individuals can take into investors. Individual investors can take a look at that area in the coming years. We spoke about long term. Secondly, interest rates most likely be high for longer. The Federal Reserve, that's for the United States, met a couple of days ago, and they kept interest rates the same. It was highly expected. However, when Jerome Powell spoke, he noted that he can't make a comment on what this is going to be at the moment because it's still unclear of how long this is going to take and what the gravity is going to be. So a lot of investors still think it's going to take a long time for this war to rage on. If it's that, higher for longer. Interest rates are going to remain higher for a while, if not that they are going to go up in the coming months across the world, not just Nigeria. So it's going to be across the world, because if it happens across the world, Nigeria, in order to make sure they can attract foreign portfolio investors, also has to keep interest rates high within the local economy. And if they do that, interest rates are going to stay high. So basically, within those two areas, energy and interest rates, the economy, interest rates are going to stay high. However, one more thing I want to mention too, if the war rages on in the Middle East and the war between Iran and the allies of the US in terms of Kuwait, Israel and some other countries in the Middle East rages on, there may be a slight shift in terms of capital inflows to the African markets within that period also. So I think, I believe that these are the shifts we should look forward to within this period if this war rages on for a longer time.
All right, Mr. Victor Lamide Mathews, it's always a pleasure having you on Business Express.
It's my pleasure.
Thank you very much.
Yes.